Welcome, aspirants. Today, we're going to break down a super important topic for your exams, insider trading. But we're not just going to talk theory. Nope. We're diving into a recent, real-world case involving the Indian Energy Exchange to really make these concepts click. But before we jump into the deep end, let's start with a core concept you absolutely have to know. What in the world is unpublished price-sensitive information, or UPSI? Seriously, think about that. Because without UPSI, there is no insider trading. It's the key.
So here's our game plan. First, we'll get the basic definitions down pat. Then, we'll see how they apply to the IEX case, look at how the whole scheme was uncovered, and finally, we'll wrap it all up with the key takeaways you'll need for your exams. Ready? Let's go.
All right, let's start by building our foundation. These next few definitions are the absolute building blocks for everything else we're going to talk about. You need to know these inside and out for your exams, so let's make sure they stick.
So what's the big deal with insider trading? Well, at its core, it's about using an information advantage illegally. It's about making trades based on what you know when the rest of the market doesn't. And that's a huge problem because it shatters the idea of a fair market where everyone has the same shot.
And this right here, this is the secret ingredient for any insider trading plot, the USI. This is that confidential bombshell, the piece of information that once it gets out is pretty much guaranteed to make a stock price shoot up or tank.
So who gets their hands on this secret info? Well, an insider. But here's what's interesting. Look at how broad SEBI's definition is. It's not just the CEO or a top director. It's anyone connected to the company in the last 6 months who might have that UPSI. SEBI casts a really wide net here, and for a very good reason. And for your exam, here's a fantastic little mnemonic to help you remember who can be an insider. Just remember the word direct. D for directors, I for influential contacts, R for relatives, E for employees, C for counsels, and T for trustees. It's a brilliant way to remember just how many different kinds of people SEBI is watching.
Okay, we've got the theory down. Now let's see how all this plays out in the real world. We're going to use the recent Indian Energy Exchange, or IEX case, to see exactly how an insider allegedly used UPSI to make some illegal trades.
So, the heart of our case study is this big crackdown by SEBI. But what makes this one so interesting is where the secret information came from. It wasn't from inside IEX itself. No, it came from a whole other regulator, the Central Electricity Regulatory Commission, or CRC.
Now, this timeline is absolutely critical. Look closely. On July 15th, there's a key meeting. Then, there's a gap of about a week. On July 23rd, after the market is already closed for the day, the CERC order comes out. The very next morning, the stock tanks. It's what happened in that gap that's at the center of this whole case.
So what was this big secret? It was a policy change called market coupling. Okay, sounds complicated, right? But think of it this way. Before, IEX was like a shop that could set its own price for power. With market coupling, a central authority would now set one single price for everyone. That means IEX was about to lose its pricing power, which was obviously terrible news for its profits and its stock price.
And the impact was, well, immediate and severe. Just look at this chart. The stock opened the day at over 169 rupees. By the time the market closed, it was down to just over 132 rupees. That is a massive drop in just a single day, all because that CERC announcement finally became public.
And this is the consequence. SEBI ordered the freezing of a jaw-dropping 173 crore rupees. That's the amount of illegal profit that 8 people allegedly made by using this secret information to bet against the stock before anyone else knew what was coming.
So the big question is, how did they pull it off? How did SEBI connect the dots? Let's dig into the modus operandi, the method they used that investigators managed to uncover. SEBI's investigation was incredibly thorough. They were connecting dots from all over the place. I mean, look at this evidence. They found frequent calls and messages. They found confidential CERC documents on a mobile phone. They had proof someone was watching the live-streamed meeting, and even got admissions from some of the accused. And the smoking gun? Their trading data showed a massive, unnatural spike in activity right in that critical period. A huge red flag.
And this quote from the official SEBI order really gets to the heart of why this stuff is taken so seriously. It's not just about somebody making a quick, illegal buck. It fundamentally rigs the game. It creates an information imbalance that puts regular investors like you and me at a massive disadvantage.
Now, you might be wondering, how can SEBI just go through people's phones and trading records? Well, that kind of deep dive investigation doesn't just happen. It's a direct result of the specific powers given to the Securities and Exchange Board of India, our market's ultimate watchdog.
SEBI has some serious teeth, all thanks to the law. For your exam, you have to remember this. The key rulebook is the Insider Trading Regulations of 2015. And that book gets its power from the main law, the SEBI Act of 1992. This gives SEBI the authority to slap on massive fines, ban people from the market entirely, and, just like we saw in the IEX case, seize all of those ill-gotten gains.
Okay, let's clear up a common point of confusion that often trips people up in exams. It is absolutely vital that you can distinguish between insider trading and another illegal practice called front running. They both involve unfair advantages, but they are not the same thing.
So here's the key difference. It all comes down to the source of the secret information. Insider trading is about company secrets. Think a merger, bad financial results, or, like in our case, a big policy change. Front-running, on the other hand, is all about pending client orders. Imagine a broker knows their big client is about to buy 1 million shares. The broker quickly buys some for themselves, knowing that huge order is about to push the price up. Both are illegal, but the information is different.
All right, let's bring it all home. We're going to consolidate everything into a final, high-yield summary for your exam revision. Pay really close attention to the highlighted keywords on these last 2 slides. This is the stuff you absolutely need to remember.
Okay, let's lock these definitions in. Insider trading. It's all about using UPSI. What's UPSI? Secret info that moves prices. Who's an insider? Anyone with that info, even if they're from another regulator like SERC. Remember, front-running is different. It's based on pending orders. And market coupling? That was the specific UPSI that kicked off this whole case.
And here are the critical facts and figures from our case study. The company was IEX. The regulators were SEBI doing the investigating and CERC as the source of the info. The amount seized? A massive 173.14 crore rupees. The stock price impact? It fell from 169.010 to 132.32 in one day. And the law governing it all? The SEBI regulations of 2015 under the SEBI Act of 1992. These are the golden nuggets for your exam answers.
And we'll end with this thought to chew on. As technology makes information flow faster and in more complex ways, how do regulators even begin to keep up? This constant cat-and-mouse game between those trying to rig the system and those trying to protect it is really the next great challenge for ensuring fair markets. Thanks for tuning in to this breakdown.